Welcome this week to my beginner's guide to capital gains tax, a tax that hits most investors on most assets sooner or later. As soon as you try and sell them, make some money, capital gains tax comes to haunt you. So that's an important area and we'll be covering it off over 3 videos. In the first video, I want to talk a little bit about the scope of capital gains tax, what kind of people get caught and on what kinds of deals. In the second video, I'll lay out a very basic calculation pro forma. It's just an introduction. In other words, I'll show you roughly how you go about calculating a capital gains tax liability. There are 1 or 2 ways you can reduce it, always useful to know in tax terms. And in the third video, I will talk about shares and the share matching rules specifically, because quite a few of you out there, if you're investors, will be most interested, I suspect, in the rules as they apply to shares, because that's something we all buy and sell quite often. So with no more ado, let's get on with the first video. What is the scope of capital gains tax? What is taxed by this thing called capital gains tax? Now, the answer contains some rather odd phraseology. Tax people don't talk in normal English. So here's a bit of tax definition for you. Capital gains tax is paid by a chargeable person making a chargeable disposal of, wait for it, a chargeable asset. So, if you have a chargeable person making a chargeable disposal of a chargeable asset, the answer is there will be capital gains tax to pay. All right, and I thought in video 1, rather than worrying about how much or how you work it out, we just worry about this. So do I need to pay capital gains tax or not? Now, tax rules are complex. This is a very basic introductory video, so I'll just give you a flavour for some of the weirdness of the tax rules, or who gets caught, who doesn't. First of all, what's a chargeable person? All right? Well, that's an easy one to answer. A chargeable person is an individual, like you or me. It could be a company, or it could be a partner in a partnership. All right? So if you're one of those 3 things, you are potentially caught by capital gains tax, but only if you make a chargeable disposal. Now, people are probably thinking, why all the posh language? You sell something. Not so fast. Yes, if you sell something as a chargeable person, you will probably end up paying some capital gains tax on the profit you make. But if you give assets away, thinking you're being clever, you're going, haha, if there are no sales proceeds, then there's no profit, and therefore I can't be taxed. Wrong. The Inland Revenue treat gifts as chargeable disposals. If you're thinking, well, how do they do that? I mean, if I give something away, there's no sales proceeds, it's free. What they do is they impute, excuse the language, a market value into the transaction. They go, well, if you had sold it, this is what it would have been worth. And so potentially you're going to be taxed on the difference between what we think it's worth, even though you haven't sold it for anything, minus its cost. And we'll look at the calculation in just a moment to give a profit. So don't think you can just give stuff away, haha, get around capital gains tax. Okay, my uncle tried this trick with my cousin. He's got a second property. He thought, I know, I'll give it away. All right, and that way we'll escape inheritance tax, which is something else to talk about in another video, and we'll get around capital gains tax. No. If you give away something even quite large, something owned in a family, it could attract capital gains tax. And there's a classic illustration there of how getting around these taxes isn't as straightforward as people think it is. Families in particular have to be very, very careful. Okay, what I mean by that is if I were to put me there, all right, and I'm trying to be a bit clever, I'm trying to sort of give assets away, the Inland Revenue will look very suspiciously at gifts or transfers between me and people above me in the family tree, parents and grandparents. They'll also look pretty carefully at anything I do on either side of me, transferring assets to my wife, am I trying to escape tax? Transferring assets to brothers and sisters, so they look kind of sideways. Be careful, don't just think you can give this stuff away and escape capital gains tax, okay? And they'll look at what I gift or transfer below me, to children and grandchildren, for example. All right, so in a nutshell, people think, well, if I haven't sold something, there are no sales proceeds, and I do it in the family, be fine. No and no. Probably not. You can still get hit for capital gains tax. Now, the third point is you're a chargeable person, so an individual, making a chargeable disposal, which could be a sale or could be a gift with imputed sales proceeds of a chargeable asset. Now, lots of assets are chargeable, shares, for example, but quite a few aren't. And the second property I mentioned is also chargeable, but quite a few aren't. So I'll just mention one or two of the main exemptions and we'll call it quits on this video. This is not the whole of the tax law, of course it isn't, otherwise how would a tax advisor make money? All right, but it is an idea as to what's not a chargeable asset, and there's quite important ones here. So things that don't attract capital gains tax, even if they're sold by a chargeable person making a chargeable disposal, you still don't have a tax bill. Your main property, your principal private residence, your first home, not your holiday home if you've got one, not your second property, not your third property, your first one is capital gains tax exempt. Nice. Okay, so if you buy a house for 50,000, sell it for 100,000, it's the one you live in, the 50,000 profit is not subject to capital gains tax. Gilts, government IOUs, no capital gains tax. That's quite a nice little perk compared to, say, shares. All right, assets that are small, worth up to £6,000, I believe the rule is. You don't want your mum doing a car boot sale down the road and having to work out capital gains tax bills on those bits of old sort of fluffy crud that she's just sold from the attic. All right, it doesn't work that way. The revenue are not going to go after everybody who makes tuppence on a tiny little asset. They want to get the people who sell reasonably big assets, second properties and shares and things, okay? Cars, slightly bizarre one. Individual savings accounts contents. Some of you out there will have an individual savings account. It may have shares in it. Okay, those shares escape capital gains tax. And perhaps the last one that's worth mentioning, the list does go on a bit, and so do I sometimes, is betting gains. So, spread bettors, for any of you out there, no capital gains tax, even if you make a profit on the bet. Okay, premium bond holders, when you win a premium bond prize, no capital gains tax on that either. And if you've ever been on Who Wants to Be a Millionaire and won it, you're probably not watching this video, but if you had done, all right, the prize is technically capital gains tax free. So I suppose that's sort of worth knowing as well. So that's a flavour of the weird and wonderful rules that come together to create this thing called capital gains tax. You need a chargeable person making a chargeable disposal of a chargeable asset, all right? And if you've got all those three things, then in the next video, I'll be explaining roughly how you work out your tax bill.